Question 1. Which of the following best describes the capitalization requirements for captive insurance companies in Connecticut? A. Captive insurance companies in Connecticut must maintain a minimum surplus of $1 million regardless of the type of captive. B. The minimum capital requirement for a Connecticut captive is determined by the Connecticut Insurance Department. CID, based on the risk exposure of the business. C. All captives in Connecticut must have at least $10 million in surplus capital regardless of the business they insure. D. Connecticut captives are not required to meet any minimum capitalization requirements if they are purely risk retention groups. Answer. B. Explanation. Under Connecticut's laws and regulations, the minimum capital requirement for a captive insurance company is based on the type and risk exposure of the business. The Connecticut Insurance Department, CID, assesses the required surplus on a case-by-case basis, taking into account the risks involved and the nature of the business insured. This flexibility allows for a tailored approach that ensures captives are adequately capitalized without imposing a one-size-fits-all threshold. Option A is incorrect because there is no fixed amount for all captives. Option C is incorrect because not all captives require $10 million in surplus. Option D is incorrect because risk retention groups are still subject to certain minimum capital requirements, even though they may be structured differently. Question 2. Scenario. Mr. Thompson owns a single parent captive insurance company in Connecticut. The company has been underwriting its parent company's property risks and is now considering expanding into liability coverage. Which of the following actions should Mr. Thompson take to ensure compliance with Connecticut's regulations for captives? A. Mr. Thompson must submit a new application to the Connecticut Insurance Department, CID, to amend the captive's license for liability coverage. B. Mr. Thompson can start underwriting liability coverage immediately as long as he has updated the company's charter. C. Mr. Thompson must conduct a full risk assessment and submit a report to the CID before underwriting liability risks. D. Mr. Thompson must only notify the CID once the liability coverage is written and operational. Answer A. Explanation. In Connecticut, if a captive insurance company intends to change its underwriting practices or expand into new areas of coverage, such as moving from property to liability insurance, it is necessary to submit a new application to the Connecticut Insurance Department, CID. This is a requirement to amend the captive's license and ensure compliance with state regulations. The Connecticut CID reviews the expansion to confirm that the captive has adequate resources and risk management strategies in place. Option B is incorrect because simply updating the charter is not sufficient for expanding coverage. Option C is incorrect because while a risk assessment may be required, the main requirement is to amend the license. Option D is incorrect because notification alone is not sufficient before the expansion. Question 3. What is the primary purpose of a protected cell company (PCC) in the context of Connecticut's captive insurance regulations? A. To offer captive insurance policies to third-party entities at a low cost by pooling resources. B. To segregate liabilities and assets within different cells to protect individual risks and limit exposure across the entire captive structure. C. To combine multiple types of insurance under one captive and minimize regulatory reporting requirements. D. To allow captives to reinsure policies written by other insurance companies in Connecticut. Answer B. Explanation. A protected cell company (PCC) allows for the segregation of liabilities and assets within individual cells. Each cell operates as a separate unit, meaning the risks and assets of each cell are protected from the others. This structure is particularly useful for captives that wish to offer multiple types of coverage, or for groups that want to have distinct pools of assets for different risks while maintaining a shared administrative structure. The main advantage of a PCC is that it provides liability protection for each cell, thus limiting exposure. Option A is incorrect because PCCS are not primarily used to pool resources for third-party entities. Option C is incorrect because the purpose of a PCC is not to minimize regulatory reporting but to protect assets and liabilities. Option D is incorrect because PCCS do not primarily function to reinsure policies written by other companies. Their focus is on segregating risk within the captive itself. Question 4. Which of the following best describes the role of the Board of Directors in the governance of a captive insurance company in Connecticut? A. The Board of Directors is primarily responsible for underwriting policies, pricing, and managing the claims process. B. The Board of Directors must ensure that the captive complies with all regulatory requirements, including financial reporting and governance standards. C. The Board of Directors can delegate all responsibilities related to risk management and claims settlement to the captive's management team. D. The board of directors does not have any legal responsibility for financial reporting or compliance with state regulations. Answer. B. Explanation. Under Connecticut law, the board of directors of a captive insurance company is responsible for ensuring that the company complies with all regulatory requirements, including financial reporting, governance standards, and adherence to the state's insurance laws. This includes overseeing the proper management of the captive and ensuring that the company maintains its financial stability. The board's fiduciary duties include maintaining compliance with state regulations, approving major financial decisions, and making strategic decisions regarding the direction of the captive. Option is incorrect because underwriting policies, pricing, and claims management are operational responsibilities typically handled by management rather than the board. Option C is incorrect because, although some responsibilities can be delegated, the board remains accountable for overall governance and compliance. Option D is incorrect because the board has significant legal responsibilities regarding financial and regulatory compliance. Question 5. Which of the following is the primary benefit of using a group captive insurance company in Connecticut? A. Group captives allow multiple unrelated companies to pool their resources, thereby reducing their overall insurance costs. B. Group captives allow insurers to diversify their investment portfolios by spreading risk among several industries. C. Group captives focus on reducing regulatory oversight for individual companies by pooling operations. D. Group captives allow a company to avoid state taxes on insurance premiums paid to the captive. Answer A. Explanation. Group captives allow multiple, typically unrelated companies to pool their resources and share risk. By doing so, they can reduce overall insurance costs through economies of scale, which is a major benefit for the participating companies. This setup helps smaller companies or companies in similar industries to access more affordable insurance coverage that they might not otherwise be able to secure individually. Option B is incorrect because while group captives do spread risk, their primary purpose is not diversification of investment portfolios. Option C is incorrect because group captives are still subject to regulatory oversight and pooling operations does not reduce these requirements. Option D is incorrect because using a group captive does not allow a company to avoid state taxes as captives are still subject to applicable tax regulations. Question 6. Scenario MS. Harris has recently formed a single-parent captive insurance company in Connecticut. Her captive has been insuring her company's property risks for 2 years. MS. Harris is now interested in expanding her captive's coverage to include employee health benefits. What is the first step she should take to ensure her captive can provide this coverage? A. MS. Harris should consult an actuary to assess the financial feasibility of adding employee health benefits coverage. B. MS. Harris must amend the captive's charter and submit the amended document to the Connecticut Insurance Department for approval. C. MS. Harris can immediately start underwriting employee health benefits policies as long as the insurance premium is within her company's budget. D. MS. Harris should increase the capital reserves of the captive by at least 50% before offering employee health benefits coverage. Answer B. Explanation. In Connecticut, expanding a captive's coverage to include a new line of insurance, such as employee health benefits, requires submitting an amended application or charter to the Connecticut Insurance Department (CID) for approval. This ensures the captive is properly licensed to provide this type of coverage and complies with all regulatory and capitalization requirements. Option A is important for feasibility but is not the first step. Amending the captive's charter with the CID must come first. Option C is incorrect because starting underwriting without CID approval is not allowed. Option D is incorrect because increasing capital reserves is not automatically required, though the CID may review the captive's capital and surplus in light of the expanded coverage. Question 7. What is the primary purpose of reinsurance within a Connecticut captive insurance company? A. To reduce the regulatory reporting burden for the captive by transferring risk to a third party. B. To enhance the captive's ability to assume larger risks by spreading some of the risk to another insurer. C. To reduce state taxes by transferring premiums to a reinsurance company located outside Connecticut. D. To ensure that the captive will be fully compliant with solvency requirements set by the Connecticut Insurance Department. Answer B. Explanation. Reinsurance is primarily used in captive insurance to enhance the company's ability to assume larger risks by transferring a portion of those risks to another insurer. This allows captives to manage their overall risk exposure more effectively and provides financial protection against catastrophic losses. Reinsurance helps captives maintain their financial stability while offering more comprehensive coverage. Option A is incorrect because reinsurance does not reduce regulatory reporting obligations, it is a financial risk management tool. Option C is incorrect because the purpose of reinsurance is not to avoid state taxes, that the arrangement may have tax implications. Option D is incorrect because while reinsurance can help with risk management, it is not specifically aimed at ensuring solvency, which is managed through capitalization and reserves. Question 8. Which of the following is a key challenge for captives in Connecticut with regard to their financial reporting requirements? A. Captives are required to submit audited financial statements annually, regardless of the amount of premiums they collect. B. Captives can file unaudited financial statements as long as they do not exceed $5 million in assets. C. Captives are not required to submit a statement of actuarial opinion unless they are reinsuring other companies. D. Captives in Connecticut are exempt from filing financial reports if they are part of a group captive arrangement. Answer 8. Explanation. In Connecticut, all captives are required to submit audited financial statements on an annual basis, regardless of the premiums collected or their size. This ensures that captives are meeting proper financial reporting standards and provides transparency to regulators and stakeholders. Option B is incorrect because no such exemption exists for unaudited financial statements based on asset size. Option C is incorrect because captives are generally required to submit a statement of actuarial opinion to support their financial health, especially if they have significant liabilities. Option D is incorrect because group captives are still required to meet financial reporting requirements, including submitting audited statements. Question 9. What is the primary legal implication of Connecticut's captive insurance laws regarding policyholder agreements? A. Policyholder agreements must adhere to the same terms and conditions as traditional commercial insurance contracts. B. Captive insurance policyholder agreements are exempt from regulatory scrutiny as long as the captive is owned by a single parent company. C. Policyholder agreements must outline specific provisions regarding risk management, claims handling, and dispute resolution as mandated by Connecticut law. D. The terms of policyholder agreements in captives are solely governed by the captive's internal policies and are not subject to state oversight. Answer C. Explanation. Under Connecticut's laws, policyholder agreements must contain specific provisions related to risk management, claims handling, and dispute resolution. This ensures that the captive is operating within the bounds of legal and regulatory requirements and that policyholders are adequately protected. The agreements must also comply with applicable state laws, including contract law and insurance regulations. Option A is incorrect because captive policyholder agreements may differ from traditional commercial insurance contracts, particularly in their structure and coverage terms. Option B is incorrect because captive insurance agreements are subject to state regulatory oversight regardless of the ownership structure. Option D is incorrect because while captives may have internal policies, their agreements must still comply with state regulations and legal requirements. Question 10. What is one key advantage of forming a risk retention group RRG in Connecticut as opposed to a traditional captive insurance company? A. RRGs are exempt from state insurance regulations, which reduces compliance costs. B. RRGs provide insurance only to their members, and members must be engaged in similar business activities. C. RRGs allow for easier access to external reinsurance markets compared to traditional captives. D. RRGs can offer insurance coverage to both members and non-members, unlike traditional captives. Answer B. Explanation. A risk retention group RRG is a form of captive insurance company where members, who are typically in similar industries, pool their resources to insure the risks of the group. RRGs are regulated under federal law, the Liability Risk Retention Act, but they must be domiciled in a state that allows them. Unlike traditional captives, RRGs provide insurance only to their members. Option is incorrect because RRGs are still subject to state insurance regulations, albeit with some federal oversight. Option C is incorrect because RRGs do not inherently have easier access to reinsurance markets, so they are still subject to market conditions. Option D is incorrect because RRGs can only provide insurance to their members, not to the general public. Question 11. In Connecticut, what must a captive insurance company demonstrate in its application to the Connecticut Insurance Department, CID, to be licensed? A. The company must have completed a risk management audit by an independent firm. B. The company must provide evidence that it has sufficient capital and surplus to cover its potential liabilities. C. The company must submit an actuarial report that forecasts the company's profitability for the next 5 years. D. The company must prove it has at least 10 policyholders, even if they are related entities. Answer. B. Explanation. When applying for a captive insurance license in Connecticut, the company must demonstrate sufficient capital and surplus to meet its liabilities. This is a key requirement to ensure that the captive can cover any claims or financial obligations. Option A is incorrect because there is no requirement for an independent risk management audit as part of the licensing process. Option C is incorrect because Connecticut does not require a 5-year profitability forecast as part of the application. Option D is incorrect because the number of policyholders is not a requirement for licensure, as captives can have a single policyholder if they are a single parent captive. Question 12. What is the purpose of an actuarial report for a Connecticut captive insurance company? A. To provide a forecast of the captive's investment performance over the next 5 years. B. To ensure that the captive is charging appropriate premiums based on risk exposure and loss projections. C. To detail the captive's claims settlement process and the average cost of claims. D. To calculate the amount of surplus needed for regulatory compliance with state laws. Answer. B. Explanation. The primary purpose of an actuarial report for a captive insurance company is to assess the adequacy of the premiums charged based on the projected risks and losses. The report helps determine if the captive is adequately capitalized to cover its potential liabilities. Option A is incorrect because actuarial reports focus on risk and loss estimation, not investment performance. Option C is incorrect because while the actuarial report may touch on claims, it is not primarily focused on the claims settlement process. Option D is incorrect because the actuarial report focuses on the financial aspects of risk exposure, not regulatory surplus requirements. Question 13. In Connecticut, how often must a captive insurance company submit its financial statements to the Connecticut Insurance Department? SID. A. Monthly. B. Quarterly. C. Annually. D. Every 2 years. Answer. C. Explanation. Captive insurance companies in Connecticut are required to submit their financial statements annually. These statements must be audited and include a detailed balance sheet, income statement, and other necessary financial disclosures. Option A is incorrect because monthly submissions are not required. Option B is incorrect because captives are required to submit their statements annually, not quarterly. Option D is incorrect because biannual submissions are not a regulatory requirement. Question 14. Which of the following is a potential benefit of a captive insurance company assuming its own risk management for its parent company? A. Increased premiums for the parent company due to higher risk retention. B. More control over the underwriting process, enabling more tailored coverage for the parent company's unique risks. C. Low reserves required for the captive, which improves overall profitability. D. Complete exemption from state insurance laws regarding claims handling. Answer. B. Explanation. By forming a captive insurance company, the parent company gains more control over the underwriting process, enabling it to create more customized coverage that fits its unique risks. This allows for greater flexibility in designing insurance products that traditional insurance companies may not offer. Option A is incorrect because captives often help control premium costs through self-insurance. Option C is incorrect because captives are still required to maintain adequate reserves to meet regulatory requirements. Option D is incorrect because captives are still subject to state laws regarding claims handling and other regulatory aspects. Question 15. What is a key consideration for Connecticut when determining whether a captive insurance company has sufficient solvency? A. The captive must have capital reserves equal to at least 20% of the total amount of premiums it collects. B. The captive must maintain reserves sufficient to cover all anticipated claims, both known and unknown, as determined by an actuary. C. The captive must demonstrate that its reinsurance agreements provide 100% coverage for any potential claims. D. The captive must have a surplus equal to the premiums paid by its policyholders for at least 1 year. Answer. B. Explanation. Connecticut requires captives to maintain reserves that are sufficient to cover all anticipated claims, including both known and unknown liabilities. This ensures that the captive can meet its financial obligations in the event of a claim. The amount of reserves needed is typically determined by an actuarial report. Option A is incorrect because there is no specific requirement for reserves to be based on a percentage of premiums. Option C is incorrect because captives are not required to have reinsurance agreements covering 100% of their claims. Option D is incorrect because surplus requirements are based on solvency needs, not a simple calculation of premiums. Question 16, scenario. A Connecticut-based captive insurance company is planning to diversify its insurance offerings to include environmental liability coverage for its parent company's operations. What should the company first assess before proceeding? A. Whether the environmental liability coverage is excluded under state law. B. Whether the company's current capital and reserves are sufficient to absorb the additional risk. C. Whether the captive will be able to legally insure against environmental risks under its existing charter. D. Whether the state offers specific tax incentives for environmental liability insurance. Answer. B. Explanation. Before expanding its coverage to include environmental liability, the captive should first assess whether its current capital and reserves are sufficient to absorb the additional risk associated with this new coverage. Environmental liability can involve significant claims, and the captive needs to ensure it has the financial capacity to cover such exposures. Option is incorrect because environmental liability coverage is not generally excluded under state law, but may require specific approvals. Option C is incorrect because captives are usually flexible in their coverage offerings as long as they comply with regulatory requirements. Option D is incorrect because tax incentives are not the primary concern in this situation of financial solvency, and regulatory compliance should come first. Question 17. Which of the following best describes a pure captive insurance company in Connecticut? A. A captive that insures the risks of a single parent company and its affiliates. B. A captive that insures the risks of multiple unrelated companies. C. A captive that is owned by a group of small businesses to collectively cover their risks. D. A captive that is established to provide insurance to third-party clients outside the parent group. Answer A. Explanation. A pure captive insurance company in Connecticut is one that is owned and operated by a single parent company which insures the risks of that parent company and its affiliates. This type of captive provides coverage solely for the needs of the parent organization and is not involved in offering insurance to unrelated entities. Option B refers to a group captive, not a pure captive. Option C also describes a group captive. Option D describes a form of third-party captive, which would likely be a different type of insurance company, such as a rent-a-captive. Question 18. What is the typical regulatory requirement for the capital and surplus of a captive insurance company in Connecticut? A. The company must have a minimum capital and surplus of $500,000. B. The company's capital and surplus must be equal to 25% of its total premiums. C. The company must have a minimum capital of $1 million with surplus determined based on the company's risk profile. D. The company must have no minimum capital requirement as long as it is a single parent captive. Answer. C. Explanation. In Connecticut, a captive insurance company is generally required to have a minimum capital of $1 million, though the required surplus may vary depending on the company's specific risk profile and business activities. The surplus requirement is typically calculated based on the company's projected liabilities and potential claims exposure. Question 19. What is the role of a captive manager for a captive insurance company in Connecticut? A. The captive manager is responsible for underwriting policies on behalf of the captive. B. The captive manager ensures the captive meets regulatory requirements and handles day-to-day operations. C. The captive manager provides reinsurance for the captive's policies. D. The captive manager oversees claims handling and directly negotiates settlements. Answer. B. Explanation. A captive manager is responsible for overseeing the day-to-day operations of the captive insurance company, ensuring that it meets regulatory requirements and managing administrative tasks such as reporting, financial management, and compliance. Option A is incorrect because underwriting is typically done by the captive's insurance team or actuaries. Option C is incorrect because reinsurance is generally arranged by the captive itself, not the manager. Option D is incorrect because while the captive manager may assist with claims administration, direct negotiation of settlements is often handled by claims adjusters or the captive's claims department. Question 20. Which of the following is true regarding the investment strategy of a captive insurance company in Connecticut? A. Captives are required to invest only in government bonds to ensure solvency. B. Captives can invest in a wide range of assets, but must follow guidelines set by the Connecticut Insurance Department. C. Captives must only invest in low-risk, non-equity assets to protect against market fluctuations. D. Captives are allowed to invest only in assets directly related to their policyholders' risks. Answer B. Explanation. Captive insurance companies in Connecticut are allowed to invest in a wide range of assets, but they must follow guidelines established by the Connecticut Insurance Department to ensure the financial stability of the captive. These guidelines include maintaining proper liquidity and solvency. Option is incorrect because captives are not restricted to investing only in government bonds. Option C is incorrect because captives are not limited to low-risk assets, so they can invest in various asset classes as long as they follow regulatory guidelines. Option D is incorrect because captives are not limited to investing only in assets tied to policyholder risks. Question 21. In Connecticut, how does a captive insurance company typically set its premiums for the policies it writes? A. Premiums are determined by the Connecticut Insurance Department based on standard rates. B. Premiums are set based on the captive's past claims experience, risk exposure, and actuarial assessments. C. Premiums are fixed at the time of licensure and do not change over time. D. Premiums are set by an independent third-party insurer with a profit margin added. Answer B. Explanation. Captive insurance companies set their premiums based on factors such as the company's past claims experience, risk exposure, and actuarial assessments. This allows captives to tailor premiums to the specific needs and risks of their parent company or group. Option is incorrect because premiums are not set by the state but by the captive itself. Option C is incorrect because premiums may change based on claims experience and risk assessments. Option D is incorrect because captives typically determine their premiums and do not rely on third-party insurers for pricing. Question 22. What is a cell in the context of a protected cell captive insurance company (PCC) in Connecticut? A. A separate legal entity created to manage all of the captive's risks. B. A designated portion of a C's assets and liabilities that is segregated from other cells and protected from creditors of other cells. C. A section within the captive's underwriting division where claims are managed. D. A fund that is set aside to pay administrative costs and regulatory fees. Answer B. Explanation. A cell ECA protected cell captive insurance company (PCC) is a segregated portion of the company's assets and liabilities. Each cell operates independently with its own dedicated capital, reserves, and premiums protected from the risks and creditors of other cells. This structure allows multiple entities to participate in a single captive while maintaining financial segregation. Option A is incorrect because a cell is not a separate legal entity but a protected part of the PCC. Option C is incorrect because cells are not defined by claims management but by financial segregation. Option D is incorrect because the cell is not for administrative costs but for the insurance risks and liabilities of its specific participants. Question 23. What type of insurance coverage is most commonly provided by a captive insurance company? A. Life insurance. B. Commercial property and casualty insurance. C. Health insurance. D. Reinsurance for other captives. Answer B. Explanation. Captive insurance companies most commonly provide commercial property and casualty insurance, including coverage for general liability, property workers' compensation, and automobile insurance. Captives are primarily used for risk retention and management, and these types of policies are typical of their coverage offerings. Option is incorrect because life insurance is less commonly provided by captives. Option C is incorrect because health insurance is generally offered by health insurance companies rather than captives. Option D is incorrect because reinsurance is not typically the main focus of captives, though they can provide reinsurance in some cases. Question 24. Which of the following is a regulatory requirement for captive insurance companies operating in Connecticut? A. Captives must submit a yearly risk management report detailing all of their operational risks. B. Captives are required to maintain a minimum surplus as determined by the Connecticut Insurance Department based on their risk profile. C. Captives must appoint an independent claims adjuster for all claims above $500,000. D. Captives must insure at least 10 unrelated entities within their first 5 years of operation. Answer B. Explanation. Captive insurance companies in Connecticut are required to maintain a minimum surplus, which is determined by the Connecticut Insurance Department based on the company's risk profile. This ensures that the captive has sufficient financial resources to cover its liabilities. Option A is incorrect because captives are not required to submit a specific yearly risk management report detailing operational risks. Option C is incorrect because while captives may have claims procedures, they are not required to appoint independent adjusters for specific claim amounts unless required by the nature of the policy. Option D is incorrect because captives do not need to insure unrelated entities. They are often used by a single parent or affiliated companies. Question 25. What is a common tax advantage of forming a captive insurance company in Connecticut? A. Captives are exempt from all state and federal taxes on insurance premiums. B. Premiums paid to captives are tax deductible as a business expense for the parent company. C. Captives are exempt from the state's premium tax, but only for the first 3 years. D. Captives can operate as a tax-free entity and distribute profits to owners without incurring any taxes. Answer B. Explanation. One of the common tax advantages of forming a captive insurance company is that the premiums paid to the captive by the parent company are generally tax deductible as a business expense. This helps reduce the overall taxable income of the parent company. Option A is incorrect because captives are still subject to state and federal taxes, although there are some tax advantages. Option C is incorrect because the exemption from the premium tax is not typically limited to the first 3 years. Option D is incorrect because while captives may have some tax advantages, they are not tax-free entities and distributions to owners may still be subject to tax. Question 26. Which of the following is the primary difference between a single-parent captive and a group captive in Connecticut? A. A single-parent captive insures only the risks of one entity, whereas a group captive insures the risks of multiple entities. B. A single-parent captive provides coverage only for catastrophic risks, while a group captive covers all types of risks. C. A single-parent captive is typically regulated by the federal government, while a group captive is regulated by state law. D. A single-parent captive is always more expensive to maintain than a group captive. Answer A. Explanation. The primary difference between a single-parent captive and a group captive is that a single-parent captive insures only the risks of one entity, while a group captive insures the risks of multiple entities. This allows different companies to share the costs and risks of the captive. Option B is incorrect because both single-parent and group captives can cover a variety of risks, not just catastrophic risks. Option C is incorrect because both types of captives are regulated by state law, although federal regulations may apply in certain cases. Option D is incorrect because the cost of maintaining a single-parent captive may vary depending on the size and complexity of the operation, and it is not inherently more expensive than a group captive. Question 27. In Connecticut, what is typically required for a captive insurance company to remain compliant with ongoing regulatory requirements? A. Annual filings of audited financial statements and a report from an independent actuary. B. A detailed actuarial report every 5 years to ensure solvency. C. Quarterly premium tax payments to the Connecticut Insurance Department. D. Biannual reports to the parent company's board of directors regarding financial performance. Answer A. Explanation. Captive insurance companies in Connecticut are required to submit annual filings of audited financial statements and reports from an independent actuary. These reports help ensure that the captive remains financially sound and meets its regulatory obligations. Option B is incorrect because actuary reports are typically required annually, not every 5 years, to assess the solvency and adequacy of reserves. Option C is incorrect because premium tax payments are generally annual, not quarterly in Connecticut. Option D is incorrect because while reporting to the board of directors may be a good practice, it is not a specific regulatory requirement imposed by the state for maintaining compliance. Question 28. Which of the following would most likely cause the Connecticut Insurance Department to revoke a captive insurance company's license? A. Failure to file an annual report in a timely manner. B. The captive's claims history exceeding expected levels by 10%. C. Non-compliance with the parent company's internal risk management protocols. D. Changes in the domicile of the parent company outside of Connecticut. Answer A. Explanation. Failure to file an annual report in a timely manner would be a violation of the regulatory requirements set by the Connecticut Insurance Department. Timely filing of reports and financial statements is a key compliance obligation for captive insurance companies. Option B is incorrect because while exceeding expected claims levels may trigger a review, it would not automatically result in license revocation unless it leads to financial instability. Option C is incorrect because while internal risk management is important, it is not typically a regulatory requirement for license revocation. Option D is incorrect because while the domicile of the parent company might affect the captive's operations, it is not an immediate cause for license revocation in Connecticut. Question 29. How does Connecticut define the risk for a captive insurance company in terms of underwriting? A. Risk is defined solely by the premiums paid to the captive by the insured. B. Risk is based on the actual claims history and future exposure of the parent company or group. C. Risk is determined by a state-appointed actuary and is not influenced by the captive's owner. D. Risk is calculated by comparing the captive's premiums to the industry-wide loss ratio. Answer B. Explanation. In Connecticut, the risk for a captive insurance company is determined based on the actual claims history and the future exposure of the parent company or group. Captives are designed to ensure the specific risks of their parent or affiliated companies, and their underwriting practices take into account the unique risk profiles of these entities. Option A is incorrect because premiums alone do not define the risk, although they are closely related to the risk exposure. Option C is incorrect because the state-appointed actuary provides guidance, but the risk is fundamentally based on the captive's own claims history and exposure. Option D is incorrect because risk is not typically calculated by comparing premiums to industry-wide loss ratios, but is based on the specific risks of the parent company. Question 30. What is the minimum capital requirement for a captive insurance company in Connecticut? A. $1 million for a single parent captive. B. $500,000 for any type of captive. C. $250,000 for a group captive. D. Connecticut does not have a fixed minimum capital requirement for captives. Answer D. Explanation. Connecticut does not have a fixed minimum capital requirement for captive insurance companies. Instead, the state requires captives to maintain adequate financial resources based on their business plan, the types of insurance they write, and their risk exposure. The Connecticut Insurance Department will review the proposed capital based on these factors. Options A, B, and C are incorrect because Connecticut does not impose specific fixed capital requirements for different types of captives.